Hello, everybody. Once again, here we are on TD Ameritrade on Twitch. I'm Anthony Panzeca, joined by
Bill Ruby.
Hey, Bill. How's it going, man?
And Producer Obi.
Pretty good. This is pretty wild stuff.
Live via Skype.
Yeah, this is, this is true streaming. We've had the comfort of our studio, but usually Twitch, you're doing it from your place, and this time we're no exception, which is great.
Yeah. How long have we been doing this for? It's almost been a year, no? I mean, what was Producer Obi?
We launched August 27th, I think it was.
Okay.
Right that last week of August. Hey, Chopper13 in the chat. Can you let us know if you hear us? This is kind of our first go around streaming from home. Give us a thumbs up or let us know how the volume is.
It's an experimental little run we got going on here, so hopefully you guys can hear us. Yeah, Chopper E13 says it sounds good.
Oh, good. Excellent. Thanks, Chopper.
How's everybody doing? I mean, my favorite part of the stream really is now that I can see the Superman logo behind Bill. It's a nice place you got going on back there. What is that a picture of there over your left shoulder? Is that some...
Over my left shoulder, that is a garden scene with a white chair.
What is it?
A garden scene with a white chair, and then on the right hand side, I don't know if you can see this. We've got Teddy Roosevelt with the "Man in the Arena" quote. So
nice. I figured the one behind you would have been like a portrait of you, kind of like twiddling your,
Oh, yeah, I took that down for the stream.
Oh, that's good. That's classy of you. We all appreciate it. Do we have new followers? Can we see that with our?
We have a lot of new followers. So as you guys know, we've been off for a couple weeks, but I'll try and run them down real quick. Ikuda, I for Bear, Joseph Get Right, Polly Math Adam. We've got Matthew Bray, Java the Gut, 618, Logic Panda, Noldy123, Homegrown Investments, MSem, Samsar, Iaser, H. Thorin, Ela Lamin Nefal, Laura Rodriguez. Oh, sorry, I got two mouse here. You got mouses, or mice, I should say.
Mouses?
Sun.
It might be mouses, though.
Yeah, in this instance, yeah. Try 84, Solarberry, John Tar, Wizard Shot the Food, Chaz Mazang. I think and Miss Ming. I think we got Miss Ming actually. So hey,
we did.
For the follow.
Thanks for the follow, everybody. Now, all of you have no excuse to not watch us now because you're all at home. And so tune in. I don't know if we're going to be doing this every week. Hopefully. I'm thinking, Producer Obi, what do you think? I mean, as long as this...
Nisha Woodbath Man is back as well. So we got the whole band getting together. We're getting back together again.
Yeah, the plan, Anthony, is we got everything moved over from the office to my apartment. So we got everything set up. This is our first actual live run from home. So hopefully everything works. Sounds like people can see us and hear us. What's interesting is you guys know you've been to my apartment. I can look out my window and see our office. Yeah. And it's like it's right there. But I haven't left the apartment in about 3 weeks. So.
Oh wow.
How about 12 days? Actually, I went to Aldi on Thursday. I mean, I'm sure everyone here has...
Going to the grocery store? Shame, Bill.
I'm sure everyone here has been pretty holed up or is trying to. So, it's got to, we do what we got to do. Social distancing, be safe.
Yeah.
This is obviously the real deal. So you got to kind of be cognizant of that and be a member of society, Be worried about it.
We welcome you for finally becoming a member of society, Bill. We do.
It only took 30 years, Anthony.
I don't know how much I'm loving the working from home, though, to be honest. I thought I was going to like it more, but honestly, I just miss seeing everybody in the office. I miss you guys, but, obviously we got to keep our distance for the time being. And a lot of times it's from people that, you're really used to seeing, you really look forward to seeing, and you guys are definitely people I look forward to seeing every day. And hope, we get back in there soon and everybody's healthy and, we come out of this as unscathed as we possibly can. So
agreed.
Well said.
About that. But so we're going to go into a few ground rules like we do every week in case we actually talk about something market related.
We will.
The stream is for illustrative and educational purposes only. It is not intended to be investment advice or construed as a recommendation of any particular investment or strategy. Bill and I are not analysts, and we cannot provide opinions on specific stocks or their performance. No ETFs if we discuss ETFs. The stream cannot be archived. Please follow the chat guidelines located below the video player on our Twitch page. And if you choose to shadow trade us in your paper money account, that is fine. However, any trade you place in your real money account is your decision alone and your responsibility to manage.
Yes.
All of those that heard that say aye.
Aye.
All righty. So,
hey, thanks, Hoplo. Yeah, I hope you're doing okay too.
Hey, Hoplo.
Hey, Hoplo, what up? So the mantra, or since we actually started Twitch, I feel like every week, Bill, it was like in Producer Obi, is that it was a 52-week high that we made every single week.
That's right.
And, it was the same repetitive story, and it was a good one, right?
Yeah.
A little different now. We saw the Dow peak out over 29,000, drop somewhere to the 18,000. Another interesting product to look at is crude oil.
That's right. I was going to say that's really been kind of the buzz all along. I mean, crude oil getting down to what I think 16-year lows, 18-year lows now.
Yeah.
So it just keeps dropping. I mean, obviously a ton of production and not a lot of demand here. I mean, they decided not to cut oil in the Middle East and Russia, so they're going to continue to produce. And I mean, I think anyone can see that this is going to have a negative effect on demand. So we're seeing the confluence of that in this chart. I mean, so Obi, by the way, people. So Obi is the only one who's going to be running our screen here. So there might be a little bit of a. We've got toss up at our respective.
He looks ready. He looks like a disc jockey in there. Look at him.
The advantage to getting the equipment and setting up is I get the good mic, I get the good camera, I got the light.
Yeah.
I don't look like.
And pretend that these actually work. Hang on.
But yeah, I'll be running the platform and producing the show. So apologies in advance if you guys if there's any lag in the screens, just yell at me.
Yeah.
Yeah. So now, Obi, let's hover over that chart. See how far back do we have to go to see these levels that we're at right now?
So I did max available, and these are monthly bars or quarterly bars, excuse me. So the lows, the last time we hit $20 oil, I mean, we're looking back at post 9/11. Basically, right after 9/11, you saw that big decrease in oil. Because remember, travel was impacted, after 9/11. So
absolutely obliterated, yeah.
Yep. So that was the last time we saw $20 oil. I was in college. I don't know about you guys.
I'm going to skip that subject.
I was not in college yet. I was not in college.
Go ahead.
Yeah, Obi does have the good mic. He raided the studio. And
maybe I can ship you guys the other two mics, and we can get you guys set up for next week.
Oh
yeah,
yeah. Thanks.
But yeah, that's. I mean,
for you, Bill, 9/11.
Mm-hmm.
You were probably just in high school too, right?
No, I was in sixth grade. Yeah.
Dude, I was a trader on the floor.
I was in sixth grade, and I remember that. That was nuts. My dad called me before school in the morning. He's like, "Turn on the TV," and I'm like, "What channel?" And he's like, "Any channel."
Yeah.
And it was all over. I mean, everyone remembers where they were that day, but.
Oh yeah.
So
has a story about that day.
Obviously, we're seeing that in the price of crude right now, and I mean, when there's low prices, you think there's opportunity, right? There may be opportunity, but the question is, how long are we going to stay down here? So with
where can it go?
Right, that too. I mean, I remember looking at it about a week ago, and I'm thinking to myself, there's no way it could drop below 37. And then if you look at the chart here, Obi, you see that if you go to one day, we blew right through 37. I mean, it was just it was just fall. It just fell out of the bed. So exactly how low can it go? So I think I've heard some, I don't know. There could be some maybe production cuts that may be able to hold it up, but it's really kind of a duration thing.
Yeah. Like, how long do you want to hold it? How much longer do you wait? How longer can it go? How much longer can it go? And I think all three of us were talking about this either yesterday or the day before when we were, kind of setting everything up and looking at crude oil contracts and saying that, hey, this might be a long-term hold here. I mean, look at the contract itself. What's the margin requirement on crude oil? It's something like 6,000 or something like that.
Right here, I can look it up.
So it's look it up real quick. It's somewhere around $6,000. Your max loss on it if you buy a one lot. What is it?
6,160.
6,160. So your max loss on a one lot is zero because it's 1,000 barrels per contract.
It's about 20,000.
About 20 grand, and you're putting up already 6 of it. You know what I'm saying? Which is very interesting that a contract with that large of a margin requirement is that low in price. I mean,
right.
You know what I'm saying? So, I don't know, maybe as a long-term investor, to buy a contract, and just put it in your account and maybe just kind of forget about it and leave it alone, leave it off to the side. Not that you'd really forget about it, but you kind of know what I'm saying psychologically, to have that kind of in the background, hoping for getting back to, $40 or $50 oil one day, because that's where it's really been long term, and we're not going to be in this situation forever, right, guys? What do you think?
Right. Well, as you both know, as I'm sure, so crude oil contracts are going to expire, right? So you can't necessarily buy and hold it for that long. You'd have to roll. There'd be some maintenance involved, and then if the price did start to come back, right now in futures, Obi, could you pull up the futures months right now for crude, the futures month prices?
So we're going to look at some backwardation and contango.
That's exactly right. Right. Now, right now, there's a pretty good contango on it. So if you take a look at the months as they go further out, you've got 2068, and then 2401, then 2674. So as we go out further, the market is predicting that the price of crude is going to come back. It's going to pop up. And that's why you're seeing the further out months at higher prices. That's called contango. If we were to see it go below, so let's say May was 2072, where it is right now, and then June was 1950, and then July was 1930, we would be seeing, that's what's called backwardization in futures. So almost all futures have a carry, right? So it's a cost of storage, right? So crude is no exception to that. So a lot of times you'll see that built in. When the prices aren't going to be, the expectation of the prices not going up is more than the cost of carry, the cost of storage, cost of production, whatever it may be, then you'll see it slip into backwardization. We haven't seen that in crude yet, but in the scenario that Anthony was talking about, if you're buying the front, and then you have to, in 20 days, this May contract, K is May, when this May contract goes into June, you're going to have to roll it. Now, you're not really, so there's a $4 debit to roll, quote unquote debit, but you're not really paying that in futures when you roll, because you're just exiting the old month and entering the new month for whatever the P&L is on the front month. So, but that's called slippage. So there'd be some slippage going into the next one, and we can see that in there. There'd be almost $4. It'd be about $3.50 worth of slippage going into the next month.
Well, then my question to you would be: is if you're a long-term investor entering a crude position in the underlying future for the first time, is it better to buy a backdated future, meaning a future farther out into the future, or just to buy the front month and to keep rolling it into the next? What are your thoughts on that?
Oh, well, it totally depends. So if you think that the contango is in line with where that's going to be, that or all of them are going to move up, then you may want to buy the May one at 20 if we're going to see spot prices. So May is the front month is always the one that's going to follow spot prices closest.
Spot market, correct?
Right. And when we say spot market, we mean cash market. Like if you were to go out there and buy a barrel of oil right now, what would you pay?
Yeah.
Right. And the futures contract should take that into account. So if you think spot prices are going to rise rapidly, then your front month is going to be it. Now, if you're worried about slippage or you don't know what's going to happen in the short term, you can get into the back month, and get into it. But obviously, you're getting a less advantageous price because let's say you're buying in that June right now, or excuse me, the July, you're paying $26.85 on the ask right now, and you'd have to expect oil to go that much higher. So spot oil would have to go almost $60 higher to get there.
Does it almost works like option decay? It's just over time, it's going to naturally fall back in. Like, because if oil prices did not move from here right now, holding all else equal, we'd be looking at a July contract, right, which is 26.75 would eventually come down to the levels that we're seeing now in the May, right? So it almost works like a decay. But I think what happens with options is they decay more as the time approaches, as it gets closer. But with futures decay, it's more of a gradual kind of segmented decay. Wouldn't you agree?
Yeah, and Bill, correct me if I'm wrong. I mean, that has to do with cost to carry. Like if you're storing this oil, you're going to have the days between today and the expiration or delivery of that contract, and the amount of time between today and that day of delivery. The day before delivery, you don't have as many storage costs and delivery costs as you do 30 days, 60 days out. So that gradual, and that's what I'm showing, just to let everyone know at home what we brought up here on the screen. This is the product depth feature under the trade tab of Thinkorswim, and this works great for futures. And essentially what Bill was asking to see was, this is that contango that Bill was talking about. You can see that the price of the near-term futures contract is the cheapest, and every futures contract, which oil is a monthly contract, you're going to see that price get a little bit steeper, but then as you get further and further out, that steepness declines. And that's because essentially that far out, Bill, correct me if I'm wrong, those uncertainties are a little bit more uncertain, or so that, what's happening in the near term isn't affecting as much as what's happening in those long-term contracts.
I mean, it sounds like it's just better if you're going to go ahead and you're going to look at crude and say, you know what, in a year or two, this is coming back. Instead of paying all that cost to carry, I mean, why would you do that? I would just buy the front month contract based on everything that we talked about. You just buy the front month and just make sure you maintain it and roll it every time it comes due.
Well, I mean, there's pluses and minuses to both. So there's definitely going to be a better liquidity. I mean, look at the volume in each of those months. In the active month, I don't think there's an exception. I can think the active month is going to be the one with the best volume. And right now, the front month has other ones. Now, crude is a very active contract, and I think we may even be seeing kind of anomalous volumes in the back months right now for crude because of this kind of drawback that we've had. But crude in any futures contract, I should say, you're going to see the volume decrease as you go further back. Crude goes out really far. I mean, so next year, so in futures, you say next year is red. I think the year after that is green. So in red and green futures, a lot of times you'll see the spreads really widen out, like, huge spreads with no volume, maybe not even a lot of open interest. So a lot of times as a give take, looks like we're getting okay volume, I'd say, in the back months in crude. So
yeah, it's a lot of volume. Even though the September contract, 54,000 contracts.
Yeah,
that's not nothing. So the liquidity, I mean, but that's a big contract though. I mean, crude oil is very widely traded. I think the E-mini is number one. The crude oil contract's got to be number two. I mean, or somewhere, at least in the top five.
I believe it is number two. Yeah.
Yeah, I mean, yeah, of course. I mean,
I think euro dollar futures are very active too. So
are they?
Yeah, I don't know where that falls. I think they're the most active options market for euro dollars, but I'm not sure. Maybe that was just for the floor. But
the other thing I would point out too, Anthony, is you could be right? Oil could be higher, say, a year from now. but you could be wrong in the short term. And depending on how much capital you have, how much quote unquote pain you can take in the short term as the economy, society, we hopefully get back to just what is, a normal lifestyle. And with that comes energy usage. Until that happens, if you say have a $20,000 account and you're taking, a dollar hit per contract every month, you might get to a point where you can no longer carry the contract, and then you're out of the position, and then oil rebounds. And that's the thing with futures is because of the leverage, you have to understand that sort of, risk reward versus how much is in your account versus how much you need to carry the position as you're taking losses, because you're going to get that daily mark to market, right? You're going to realize those losses every single day, so you need to have that cushion in terms of account size to manage that.
Yeah.
Now Zerengau brings up a very interesting point here in the chat. So do you consider buy calendar spread on oil futures CLK versus CLQ? So he's talking about CLK, which is May, versus CLQ, which is August.
I want to know where Hoplo went on his honeymoon. That's really the question of the day. He can't travel anywhere now. At least he finally got to get out and he came back in time. Where'd you go?
Yeah, I've barely been outside, much less on a honeymoon or a vacation, whatever it is. I actually had a trip to San Diego planned that I had to cancel.
Oh, brutal. Yeah, that's a trip that you won, by the way.
Yeah, that's right. Yes.
So Bill.
Yeah.
Bill, so on the platform, right, we're going to the spread, which is normally at single. I'm going to change that to calendar.
Good to see you, Dark Superman.
Well, here's something. Well, before you get into that, there's something I want to talk about with futures calendar spreads, okay? That's very important. The calendar spreads in futures, you're probably going to be in different months in the futures, in the options, okay? So this is different than equities. Okay, whereas in equities, when you do a calendar spread, you're going to have the same exact underlying. Both are being followed by the underlying stock price. Now, in futures options, you have a different underlying for both of those. The May option will be determining price based off the May future, and same for the August, respectively. So those can move in completely different directions. Let's say, for instance, OPEC says they're planning on cutting production in July. You'll see May stay probably real close to where it is based off that move, but August would explode because we know that there's a production coming in July. So if you could have totally different movements in those two different futures months. Okay, so it's very different than doing a calendar spread in an equity. You're actually doing a futures spread, is what we call it. It's a month spread. You can actually trade that vehicle itself. Like I want to trade the May future versus the August future because I think that spread is going to increase or decrease based on the movement of that backwardization and contango that we were talking about earlier. So there's a whole different risk profile of doing a calendar spread in a futures contract than there is to an equity.
Now, Bill, walk me through that on the platform real quick, because I know functionality-wise, if we wanted to buy that spread between the near-term future and August, how do I walk through that? I have the spread.
So you do it the same way as you would now. Oh, you're trying to do the futures spread itself?
Yeah. How do we queue that up as an order just to see?
Well, there's a couple ways to do it. Why don't you switch that to instead of the single future? Mm-hmm. We're going to go to calendar.
Okay.
Now notice that
there we go.
It's expandable on each of those.
Yeah, there we go.
You can see the spread in those. Now spreads while traded, and probably in something like crude would still have pretty good volume. Spreads have much lower volume than the underlying. There's got to be people who both want to put on both those positions at the same time, selling the front and buying the back. So you'll see volume go down a lot. In crude, that's not as much of an issue as we'd see in something else, but you can still trade it here in this area. And notice there's an NA in some of those. That means the market may not be there. That means that it actually isn't traded, and Toss is bringing it up on there. But those will still be there. I'd make sure that if you are entering into something like this, that you make sure that there's at least somewhat good liquidity. Be very cognizant of your bid-ask spreads. Now, also another thing is, so if we were doing something like calendar spread, that's a volatility play. We're expecting it to come back into a line, especially with something like earnings or pending news. In futures spreads, they don't necessarily need to get back in line before the front month expires or before the first contract month expires in there. And then not only do the first one roll off, whether you close it or not, but then you have this remaining open singular position in the back month. So there's a lot to think about when getting into calendar spreads. I definitely play around with it in paper money before you decide to enter something like that for the first time.
That is so interesting. I was kind of like saying before, options are complicated enough to learn, and then to look at, you basically have to segregate it. It's not like a stock, right? A stock is consistent. Apple stock was the same, not price, but you're still getting the same thing when you buy a share of Apple stock as you did 20 years ago. Mm-hmm. But with the crude oil contract, you're actually getting a different delivery month. So that can contain a whole different package of variables that go into the pricing of it. And so you could take advantage of that through futures options. To be honest with you, I've never been a futures trader, never been a futures options trader. I mean, I know about it, but I've never done it personally. But my head is exploding right now. But it's a different something on. I mean, why not? If you're a long-term investor, why not scale in possibly? Maybe, I know it's hard to scale into a position in crude with a huge margin requirement like $6,000, but maybe we can put a mini. They have a crude mini. It's /QM. We can maybe put one in our account, just chill with it for a little bit. Maybe we go down to 18. Maybe we buy another one. Maybe we go down to 15. Maybe we buy a big one at 15. I don't know.
we could do something with that. I mean,
how long can we really stay at these levels in crude? I guess we can for a while, right? That's why it's there. But we're always going to need it. Go ahead.
Even if just the U.S. stays at where it is, where we're doing this lockdown, I mean, we could be down here for at least a month. Where recommended, what's it called? Stay at home. The recommendation is till April 30th at least.
I don't know. I turned off the news, Bill. There's no good news out there anymore. I can't stand it. I was watching The Fresh Prince of Bel-Air. I was like, turn this stuff off. I need to watch.
That's what staying at home will do to you, though. You're kind of ripping out the deep tracks to watch. Fresh Prince is a good choice. Yeah, no problems there, go. But yeah, we could put something on a crude. I think there's something to be said here. I mean, what kind of example trade would you want to do here?
We could keep it simple. I think that if we start talking about calendars and stuff like that, to be honest with you, that's almost confusing to me. I'm almost thinking, hey, why not just sell an out of the money put? And if we get a future put to us, we'll keep it on the side and we'll sell another put after that and kind of maybe accumulate or scale into a long-term position like that and see what happens.
Yeah, we could definitely do that. I mean, we do have pretty good implied volatility, as you'd expect in these crude futures. Let's take a look.
Bring up an option chain for crude.
Mm-hmm.
I'm having a technical difficulty on my end, so I can't see actually what you bring up, but I can duplicate it on my screen. So let's use one for example here, okay? Like if we looked at that May expiration there, it has 15 days left. Okay, right now we're sitting at, let's make this real easy so for people to understand, right? So we're sitting at what in the May contract?
2028, 2029.
Okay, awesome. And now look at the 20 put that expires in 15 days.
It's a 230 bid offered at 233.
Right. So if we go ahead and we sell one of those, that brings our break even down to what now? So this is it's
1770 basically, right?
Yeah.
20 minus 230.
Okay, so here's where we're getting at, guys, is that if we were to have that future put to us on that particular futures option, we would have the future put to us at $20. And as you can see right now, it's trading 35 cents above that. not only would we be buying it at 20, which is lower than where it is now, but we're also getting to keep that premium. So you have to add that back in there. So that brings that right there. That brings your cost, your how much you paid, your average cost for the contract down to what, 1775? You said 1770.
Right.
I mean, so we're really betting against 17, something dollar oil. And if we get the future put to us at 17, I'll take it. And then maybe if it's at 17 at that point, we'll sell the 15 and we'll take it that way. I don't know. Like, I'm just kind of looking at this just, hey, I don't know.
Yeah. And now keep in mind, I mean, that's a big trade, right? We typically don't do trades that big. Usually we have something, if we do something in a future, the margin requirement is going to be right around 6,000 for that, which is very close to the margin requirement of doing the underlying future. Now, we could certainly do that, and that way we'd be lowering the cost basis if it did go down. It would just be I'm just saying that would be a large trade for us versus our typical size on margin requirement. But we could do it just to watch it.
Like at $20, I mean, I understand what the risks are, but how scared are you at 20? Actually, in not only we wouldn't even be paying 20, we'd be paying 17.75 a barrel, And then, but like I said, we could scale into a longer term position and maybe accumulate over the next couple of months and kind of see what happens. Because I don't know, we haven't seen this level in crude oil in a long time. And maybe these are, the times where, the situation that we're in, if we see something, we can, we could scale into something smart.
Right. So, and Serengal brings up a good question to ask yourself when you're doing this. What if May crude goes down to 10, right? And we're short that $20, right? So we would have collected $230 for that roughly. And it goes down to, if it goes down to $10,
$7,000,
we'd be down $7,000 on that trade. And not only that, we'd have to have that $7,000 and enough maintenance requirement to handle that position. So it'd be, which would be even more. Okay?
Yeah,
so got to have quite a bit of capital in order to be able to maintain a trade going against you in that scenario.
Yeah, if that happens, we could just sell the 10 put. Eventually, we're going to be right. It can't go down forever because it can't go to a negative.
You can never say it never would.
It can't go down forever, and that is a fact because it'll have to stop at zero. It can't go then less than that, right? And guess what? You know what? I'm sorry. I don't think we're going to zero in crude anytime soon. I don't see it.
Fair, but
I'd be careful in saying any kind of absolutes like that, considering we don't know how long this is going to last. We don't know what Russia and OPEC is going to do. We don't know what production cuts are going to come in.
Chopper's right. Say never.
Yeah. But yeah, from just a standard, no guarantees. To your point, Anthony, we know the risk here, right? And this goes back to our conversation from earlier. You would need a probably a larger size account to do a trade like this and take any kind of medium to long-term pain on this trade. If you were doing this with a $20,000 account, probably not a great idea. Especially what we said, the margin requirement is 6,600 roughly for one contract. So you have to know what you're doing on this if you're trading futures. And as we've seen since the start of this pandemic, every time oil has hit a new low, someone has gone out and said, "Oh, this is the bottom for oil. This, oil can't go lower," but it has. So I'd just be very careful to.
And also, Anthony, just the nature. Oh, sorry. Go ahead, Anthony. Go ahead.
No, go ahead. I can't tell if you're talking sometimes because of the audio.
Yeah, you're cutting in if we talk at the same time. But so if you let's say we sold a put, okay, and then we get delivered on, I think the May was May contract, the one we were looking at. Yeah, so if we get delivered on the May, right, and then let's say we get out of that and sell another one, right? What's to say that the back months don't rally and then we're stuck holding the bag in the front? Right, so it's hard to say that it doesn't necessarily work like that. We could still get run against, and then the back months rally, and then we're selling a $22. We're selling a $28 or $30 put if the back months rally to get the same amount of premium to help pay for our front position. So there's risks involved with that too. It's not as linear as it would be in stock. There's a disconnect between the futures contracts. So there's some nuances to that you have to be aware of. And of course, like Obi was saying, I mean, we could stay down here a while, and we could go lower. I mean, with
Zarengo brings up a great question. What if we did a short put vertical to limit our risk, right? Say the 15-20 put spread. We define our risk.
I'm fine with that.
Yeah, I think so too. And then if that works, we could essentially roll that. So, I mean, we're limiting our risk. We do still have that contango backwardization risk, but we're focusing on one area, right? And that would also lower our margin requirement. That is only $5 wide, $5,000 in crude. That's going to be our max loss minus our credit, whatever credit we may receive. So that's going to lower our margin requirement as well. I think Zarengo is onto something with that.
Well, here's the thing: it depends what your investment objective is. If your investment is to, can you guys hear me?
Yeah, we can hear. We're just saying hi to Dow Kid.
If the objective is to get along the future, then we would sell the put outright if we're okay taking delivery on it. Selling a credit vertical on crude oil that starts the genesis of that trade is different because it's purely for speculation in the options markets, trying to take advantage of premiums there. And my whole premise to this, and we could do that if you guys want to, but my whole premise of this and the genesis of what I was thinking, it was to get long crude oil contracts as cheap as we could for the long term and hold them until we can sell them in the future. That could be a great strategy too, because we're looking so cheap down here, right? With the underlying price is $20 and the implied volatility is high. As you can see, we're looking at 150 vol.
I think but futures are really a short-term vehicle. I think if you're looking for something like that, you'd be better off finding a company that moves, which there are plenty of companies that move in lockstep with the crude future, right? So if the crude,
if you did that in Marathon, look at MRO. Pull up MRO, Obi. I mean, that stock, is absolutely annihilated, and not that you can't get annihilated in this too. I mean, but. They're futures. They're highly leveraged. We can get nailed. So
what's that symbol again, Anthony?
MRO.
MRO.
Yeah, Mary Robert Oscar.
Marathon Oil. Got it.
Hammered.
Right, and these can, if you think this company is going to be able to weather the storm, obviously you'd want to look at, all the risks involved with trade and equity again. But these kind of companies seem to follow pretty closely with the price of crude. There's production companies. There's different refining companies that all are going to move in lockstep with the price of crude. And if you're looking for a long-term play, you may be a very long-term play, like an investment. Like you may be better off looking at those kinds of investments where you're going to be able to hold for a long time, where you won't be as chained to both the delivery and the roll in between these futures contracts.
Several interesting points, and you know what? What's another thing you can do too? If you're somebody that wants to get long in that sector, you don't have to necessarily go in. I'm sure there's a lot of people out there saying, "Well, I don't have a futures, whatever. I don't know anything about that." Well, fine. Now with zero commission trades, you can bring money into TD Ameritrade. Let's say it's 10 grand and scale into a position over the next 6-12 months. Maybe you buy one share of BP today. Maybe you buy one. So that's British Petroleum. Maybe in a couple of days you buy 2 shares of Royal Dutch. I'm not saying that's the exact, but you can accumulate and scale into a pretty sizable position, because you got to think about when you bring dollars into a brokerage, you're not just bringing in money, you're bringing in ammunition, you're bringing in bullets, and each dollar you bring in represents a bullet. So when you're on the battlefield, boom, buy a share of Royal Dutch, buy a share of Marathon. I'm not saying particularly those, Halliburton, anything that's connected to the price of crude oil, you can really scale into a good long-term position that way.
And what you're bringing up, Anthony, is dollar cost averaging, right? Scaling in, right? So not necessarily recommending these particular companies or that you should invest in oil stocks right now.
Yes.
But the idea, and this I think is the theme of what you're hearing on just about any financial news network right now, is how do you deploy capital when stocks and other products are at levels we haven't seen since before President Trump was elected. Some stocks even more so that have been beat up, say, 70, 80, 90%. If you have long-term conviction and if you are investing for the long run, how do you deploy that capital? And this is, I guess, a question for you guys. And chat, feel free to ask any questions about this. But for the last 10 years, the main mechanism for investing has been passive investing, right? Investing in index funds, mutual funds. There's certain ETF products that cover a basket of stocks that track the entire market. Now you're starting to see that shift towards active trading. Active investing, meaning you're picking specific stocks versus the basket. And this is where, maybe you need to use a financial advisor. Maybe you need to do more homework than you've had to do in the last 10 years because the market isn't just going straight up anymore. You've got to find those opportunities. So the question to you guys is not necessarily about oil or a specific stock, but what are the things you guys look at when you're evaluating a company, when you're evaluating a stock to maybe make a long-term investment? And to your point, Anthony, using those bullets slowly as that stock price comes down, you can average into a good cost basis and hopefully in the long run take advantage of that.
So one thing before we do that, M. Gunther, you can't line it up, the stock versus the futures movement. You can't really line it up on toss. It's you'd have to kind of look at it versus the chart, I think is the best way. Maybe the comparison tool in the chart, and we can go over that in a minute. But as far as picking a stock, it's a lot of it right now, I feel like, and there's been a lot of chatter on like CNBC and whatnot about fundamentals. Everything's gotten hit with this, and in a portfolio, you can diversify away against single stock movement and how much it's going to hit your portfolio. But when you get a systematic move like this, when you get the entire market going down, there's not a great way to diversify away from this, except for choosing companies who are going to benefit from the type of drawback that we're having. This is obviously an economic slowdown due to coronavirus. People are indoors. People can't spend money, can't go out, that kind of thing. So we're seeing a lot of that. Now, there's other companies like Zoom or Workday that have been benefiting from these. Well, maybe not Workday. I think they had bad earnings. What is it, Slack? I think Slack has been coming back some based off that. So those you can't really foresee these things coming. You have to know what type of crisis you're going to be in beforehand, which we all know is impossible to know which ones are going to benefit in the type of drawback that we saw. But once we're already down here, you can find companies that are in good positions to grow, where they maybe haven't been as hurt. Maybe they had a large cash position coming into this. Maybe their debt to equity ratio, even after the hit, has not been as bad as it will be as other companies in the same sector. A lot of this is, when looking at stocks, it's looking at other companies in different sectors, right? Which one is going to be the one who can excel moving forward out of this, based on their balance sheet, or based on it could be a bunch of different things, based on their positioning, their region, their management, who you think is going to be able to navigate this best. It's a lot of those kinds of things. But just like you said, Obi, all that requires research. It requires time, and you've got to really put in the time to find some winners, because there are going to be some big winners out of this. People who forge out of the crowd, or when the herd is culled by this thing, by this drawback, who's going to be able to sponge up the rest of that business. And there's certainly opportunities like that, but it's got to be it's got to be. It takes a lot of research. And wait, could we pull up the chart for Zoom? I think because they've been one of the ones who've really benefited from this.
They've definitely benefited, and you see, like Amazon is pretty much kind of held its ground, right?
Right.
In 1950. I mean, I feel like it's been there for a while, almost all year long. I mean, and then other stocks like household names like Apple have been absolutely destroyed. Netflix, well, there's nothing else to do besides sit home and watch it. Start watching
what's the symbol on Zoom? I don't think I'm bringing up the right. ZUM?
ZM.
ZM, thank you.
Netflix, well, there's nothing else to do besides.
Well, I'm having a tech issue. 1 second.
You unmuted.
I can hear myself talking.
Question for you, Anthony, and this is.
Well, I'm having a tech issue. There we go. Sorry about that.
Thanks, Bill. Question for you, Anthony. You know, the other theme that I'm hearing a lot is we're in a bear market now. So, you know, the mechanics of a bear market are different than what we've seen over the last 10 to 12 years. So, you know, you might see huge snapback rallies and a lot of people selling rallies as opposed to the buy the dip mentality. Kind of, you've been through a few bear markets, I assume, on the floor and in 08. Just talk the audience through real quick. Just what is that like from a trading standpoint? What are things you look at? And things that might catch your attention during a bear market that we're seeing.
The toughest part about a bear market is having money to buy anything after you get knocked over the head, right? And so that's what you're seeing a lot of traders like right now that have taken significant losses and didn't have their portfolios hedged in such a way where they had money at the end of the day to do anything with. And the most failed opportunities that I've seen in the past is not protecting yourself, not over in an over leveraged account. You get burned so bad by maybe making unrisk defined strategies, not taking risk defined strategies, or over leveraging your margin, and then your account blows up. And then when those opportunities come to accumulate a position like that we've been talking about, you don't have the bullets to even go into battle, So I think the most important thing is along the way is to always keep a well-diversified portfolio with defined risk strategies. That way, when times like this occur, you maybe even have some extra savings that you can bring in and pick your spots. A bear market should be welcome to any investor out there. I mean, if the market just went straight up all the time, no one would ever afford to be able to get in. Okay, I mean, look at housing a few years ago when that kind of got away from us in the bubble. The average person couldn't afford a house unless they lied about their income. I mean, so really in this type of environment, you have to welcome it and you have to look for your opportunity and scale into a position slowly and always stick to not over leveraging and sticking to strategies that are risk defined.
And that's something we've talked about in the past a lot. Save a couple of bullets. Like being aware of how position sizing so that you can take advantage of opportunities when they come about. I think there are a lot of opportunities here. It's just you've got to go in, you've got to do your reading and make sure that you're choosing the right ones because this, I think we're down. I don't even think we read the markets today. Just because we got right into crude. But, the Dow is down 851 to 21,066. SPX is down 105 to 2478. And the NASDAQ is down 300 to 7,400 essentially. So, I mean, we're down today. We could be down more. This is not necessarily over. I think we've seen a little consolidation in the last few trading days. That could have been to us coming, into the end of the quarter with both, a bunch of funds having to rebalance their portfolio, people finally being able to handle margin calls and be prepared to move stuff around, moving money around, giving them a couple days. But this could go further. This might not be the end of it. So you have to really make sure you're saving some bullets so that if you see an opportunity, you can take advantage of it, whether it be in the equities market or the options market, and also really do your research. Make sure that you think this company has some staying power even under the current situation.
Yeah, that's and just so you guys see what I brought up on the chart, I basically did a 90-day 1 hour chart and kind of track the lead in and then the sell off and kind of where we've rebounded here over the last week or two. What's interesting, you notice how small the candles were when VIX is
Look at that.
when VIX is at a 10, 11, 12, you are going to get such small daily intraday movements. And then once you see VIX spike to 20, 30, 50, I think we got up to over 80 in the worst of it recently. You can just see how much more volatile the intraday movements have been. And I think that's been the most fascinating thing in this is we're seeing 100, 200 point swings in the S&P 500, 1,000 point swings in the Dow. If you're trying to trade this market, you have to be so nimble and so careful about how you're deploying your capital because, once again, we talked about you could be right, but you could be wrong in the short term because you were on the wrong side of the swing for maybe an hour or two, and then that position comes back and would have been profitable. So you can see that, this is probably our first first big sell-offs in the last couple weeks. And that I think is due to a lot of what people have been saying is portfolio rebalancing in the last couple weeks of the quarter. So just interesting. Curious on your guys' thoughts on the tape that you see here.
I love that you used the word deploy because I feel like that fits right into the battlefield type of, metaphor that, we were talking about before. And then going into battle, with your ammunition, you have to be wise in the which way, you deploy your capital. And in a situation like the one we're in now, you talked about bear markets before, and there's always going to be this hindsight where we're, like, man, I could have got in on all of this stuff and I didn't time it right, or I didn't have enough money, to be able to do anything. Or maybe I had $5,000 and I went in, I tried to get into the market at a 45-degree angle and I got burned, like by getting in too early. And I think really scaling into, a strategy, just, if it's 10 grand, maybe you budget it out over 10 months and you spend $1,000 a month buying stock, right. or something like that, or something, and if you're going to use a margin account, maybe you're spending a little more, right? But again, not over leveraging, but the point is to have enough bullets to be able to take advantage of this long term. I don't know if that even answered your question, but I just wanted to add to it.
No.
Well, I mean, so we pulled up a chart of the ES, right? And we've talked about VIX in the future. VIX has been crazy high. I think it's been the highest since 1999 on the dot-com bubble, I think. Or, 2000, 2001, that kind of thing. Dot-com bubble and 9/11. Double check me on that. But anywho, so that kind of volatility is just what Obi says. You have to be able to take the heat to give yourself to be time, right? Anthony's talking about a strategy that can fix that, where you're not putting all your eggs in the basket at once. Now, when it comes to options, which is what we usually talk about, and we've been talking about it less because, equities have kind of been the story, but options are going to be super expensive right now because the VIX is so high. Okay, anything you buy, virtually anything, is going to be higher than you would have paid a month ago based on the distance relative to where it is, the percentage move of the underlying. So you have to be cognizant of that. Now, we've talked about in the past that selling volatility is a good way to take advantage of high volatility. But that is absolutely true. When you have high volatility, you're going to be getting better premiums, better things. But then that slides right back into what Obi was saying. You need to be able to handle the metaphorical heat that we've talked about, handle the pain in order to be able to be right. Because when you're using a leveraged product like options, 1 to 100 with stock, you're going to see probably at some point some swings where you're really getting beat over the head, even if you're eventually right. So yes, and that's why defined risk strategies could mitigate some of that. Now, defined risk strategies right now with the VIX high, you may be getting a little bit of credit, but this is where a lot of times in a lot of symbols, the skew is going to come. We've talked about the skew in the past as well. You're selling one option, but you're buying another one. So a lot of times that implied volatility can cancel each other out, and you're not getting as much of a much premium as you think that may be warranted, shall I say, in that situation. So once again, you got to pick your opportunities. Be a little discerning. Be a little picky. Make sure that you're getting the premium that you want, because chances are at some point it's going to be a loser, even if it's eventually right.
Yep. And to answer your question, Bill, looking at the VIX chart here,
Yeah.
the last time we saw 80 VIX was during the financial crisis in October of '08, so just post Lehman Brothers collapse. Peaked out in October of '08. The last time before that was the '87 crash. So,
Wow.
So we're looking and assuming that this data is
172. Sorry,
assuming the data is correct. I went to a VIX all-time monthly chart. So assuming the data is correct, then we're in a essentially once in a generation type volatility. We've only seen that twice in the last 40 years. So, and what's interesting, isn't it kind of crazy? VIX right now it's been hovering around 60 over the last week. It almost feels like 60 VIX is now 25 VIX from a few weeks ago. It's all relative. It's just kind of crazy. But we got 5 minutes left, guys. So anything you guys want to talk or do as we have 5 minutes going in the close of the stream here?
Well, I could blabber for a little bit longer, but if the chat has any questions, try and squeeze them in, because we do have kind of a hard out today. If you guys have any quick questions, we can fire those off. Anthony, you have anything you want to say?
I have an idea. It's a trading show, so maybe we should put on a trade.
Right.
Lightning round, because that always has worked out well for us.
I don't know about lightning round. I just thought about crude oil, and let's going back to what we could do before. I mean, are we interested in selling a put or a put vertical there?
I think a put vertical would be better. I mean, if we wanted to sell a straight put, I think we should do it in the front month to show management. It's up to you.
Both strategies kind of side by side to see what would have worked better.
Okay, we could do that.
It's an educational show. I mean, let's just, who cares about the P&L so much to the point where we still want to educate people. And I think it would be a good comparison to see what strategy would have worked better. So we can look at selling the 20 put, right, just slightly out of the money there, because I think we're at 20.50 now. I think crude moved up a little bit.
And this is the May contract again? You're talking about the CLK 20?
Yeah, it's going to be the CL. The QM, the 500 barrel, does not have futures options.
Got it. So you want to sell the 20 put. Right now it's 216 bid, offered at 220.
216. We could have got 230 before.
And and just to remind the audience, we're working with a demonstration paper money account that has about $1 million in it. So we clearly have the funds to withstand some pain. But I think to your point, Anthony, this will be kind of cool educational example with futures options to show people how these work and things to consider over the next couple weeks.
Yeah, let's do it.
All right, I'm going to throw it in at the mid price at 220. Let's see here. We are selling.
It's collecting $2,200 if we get filled to 220. It's $1,000 a handle or $1,000 a full point.
Mm-hmm. All right, we're filled. We sold one May futures contract, not May futures, one May CLK 20. We got filled at $2.20. So we're short one put in oil for the next 15 days.
Mm-hmm.
Nice.
All right. Now, do we want to do a spread, or do we just want to do this one for now? I mean, run a little.
We're at 1 minute, so let's. Why don't we say our goodbyes here, Anthony? I'll kick it over to you.
All right. We're not going to sell the vertical. We're just going to leave it.
Well, we'll look at it next week. Yeah.
Yeah, we'll take a look next week.
All right. Well, you know what? Producer Obi, are we going to be? Are we going to be on next week, maybe, or what's the deal?
That's the plan. As long as the technology's still working and you guys are available, we'll be here again every Wednesday, 1 to 2 p.m. Central Time. And I will do my best to maybe get you guys some microphones and maybe some light and make you guys look all pretty.
Professional, like your little.
About time.
Like your little perfect studio over there, looking like a disc jockey from the 90s.
What can you say? The producer has all the power.
Put it in all the trades.
Yeah, well, I thank you guys for joining us.
Late night FM radio.
It looks like we're going to be on. You heard Producer Obi, 1 to 2 p.m. Central next week. So obviously there's a lot going on. We're looking at the markets right now. Dow down 950, NASDAQ down 338, the S&P 500 down 117 handles. Bill, speaking of handles, what's your Twitter handle?
It is WRuby_ at TDA. Oh, I did it again. WRuby_ TDA. I don't know why I do that every time. WRuby_
_TDA. Check out all of our great educational material on the platform under the education tab and on the website. Other than that, till next week, I'm Anthony Panzica.
I'm Bill Ruby.
And I'm Producer Obi.
Hey, Producer Obi.
Oh yes, and Producer Obi. How did I forget? Oh, he's gonna shut my mic off next week for that one. All right, we'll see you guys.
Hey, thanks for coming in. Thanks, Dow Kid. See you, everybody. Stay safe.